Investment flash.
AI boom, small cap rally, record leverage. Pick your poison. It's a market full of opportunities and landmines, and we're breaking it all down.
I'm Marie. This is Investment Flash, London edition, Friday, July 3rd. With me are Tom and Gerald. We've got a packed show. AI hardware, defense tech, a really interesting contrarian dollar call. Let's get into it.
All right, first up, AI infrastructure demand is still insatiable. Nikkei Asia says Unimicron's market value surged 350% this year. South Korea announced a $600 billion chip expansion. And a fund manager told MarketWatch he's explicitly buying NVIDIA and SK Hynix while dumping software. The hardware trade is on fire.
Yeah, and that's the same fund manager who probably buys high and tells everyone after he's loaded up. But look, NVIDIA at 15 times forward earnings isn't insane. The growth is real. My issue is with the crowding. When everyone's long the same trade, any hiccup, and it's a stampede.
No, Gerald, I'm going to push back. The supply chain bottlenecks are actual constraints. TSMC can't build fabs fast enough. That's not narrative, that's physical. And Apple's planning 5 new iPhones to take market share during the memory crunch. That's a bold offensive, not just momentum chasing.
Exactly.
Right.
Spot on.
Marie, you sounded like me for a second there, bullish on Apple and chips. But she's right. The valuation on these names isn't stretched. You get actual orders backing it up.
Fair enough. But remember when Tom said semis were cooked in Q2 last year, and then they rallied 60%? I'm just saying, a broken clock and all that.
That's brutal and totally fair. But this time it's different, buddy. We have AI, not just a restocking cycle.
Wait a second. The "this time is different" flag is already waving. Tom, you literally just said that about defense yesterday, and we're flipping that call today.
Oh man, you got me. All right, we'll get to defense later. Let's move to private equity. Apollo Global is struggling to sell a Hispanic grocery chain because immigration raids are scaring off customers. FT has 2 reports on this. A single deal story, but it's a fresh policy risk that's not priced in. We're saying sell Apollo.
11 times forward PE ratio and a 25% discount to its high. You'd be shorting a stock that's already priced for a lot of bad news. But, to be fair, the immigration angle could get worse, so I see the downside.
It's not just Apollo. It's any private equity firm with a big consumer portfolio. If raids hit foot traffic, that's a material headwind. The press isn't connecting those dots widely yet.
And speaking of drugs, the WSJ's most original take today is on weight loss drugs. Medicare coverage looks like a big win, but they argue it's not going to be the revenue gusher Wall Street expects. Utilization limits, prior authorization, pricing negotiations. Novo Nordisk and Eli Lilly are holds.
Exactly. Lilly at 27 times forward earnings and near its all-time high, the bar is very high. If Medicare math doesn't add up, that optimism gets punctured fast.
Right, because nothing drives stock prices like government bureaucracy and pricing negotiations. I'm sure the analysts with their models have factored in the complexity of CMS.
Haha, fair. All right, next signal, dollar weakness. Bloomberg reports Credit Agricole, Morgan Stanley, and TD Securities are all challenging the consensus dollar bullishness. Rare coordination. The euro is the natural beneficiary.
This is a big contrarian call. When 3 major desks warn the dollar is overbought, the risk-reward favors fading the rally. Buy the euro against the dollar.
Yeah, look, the ECB isn't exactly hawkish, and the Eurozone has its own growth challenges. But if the dollar turns, the move could be sharp. I'll watch it.
Crypto time! CoinDesk says Bitwise sees the strategy sell-off not as a breaking point, but a late-cycle leverage unwind that historically marks a bottom. They predict institutions will replace strategy as the biggest Bitcoin buyer. Buy Bitcoin, hold strategy.
Oh, the old, it's a bottom because everyone's given up call. Strategy is 78% below its high.
For real, that's a lot of pain. But institutions have been about to buy for years.
Hold on. The structural shift is if institutions start buying directly instead of through a leveraged proxy-like strategy. That's different. It would actually be healthier for the market.
Right, and it aligns with the broader move into spot Bitcoin ETFs. The flows are real. I get the skepticism, but the contrarian play is long Bitcoin here.
All right, buddy. Let's see if you're right this time. Now, China Autos. Nikkei Asia reports Chinese automakers, led by BYD, overtook Japanese brands in Europe in May. That's a structural shift. Buy BYD, sell Nissan and Toyota.
But Tom, the very next signal group is China consumer, where subsidies are fading and auto sales are crashing. BYD's domestic sales already fell 16% in the first half. So we have a conflicting signal. Buy on Europe, sell on China. Which is it?
Look, the European breakthrough is the fresher data. Overseas sales up 70%. That's a credible growth driver. The domestic weakness is a cyclical problem, but the structural story is export share. I'm leaning buy.
Or it's just a tariff-fueled front-running ahead of more barriers. Toyota isn't exactly rolling over. I'd sell Nissan, though. They're retreating from Europe already.
No, but that's exactly my point. BYD is facing headwinds at home and tailwinds abroad. It's not a clean trade. The China consumer sell signal on the large cap ETF is clear. It's near its 52-week low, and June sales collapsed.
Fair enough. Defense tech. Quantum Systems valuation doubled to $8 billion on a $1.2 billion funding round. That's a massive vote of confidence. We're buying the Aerospace and Defense ETF.
Tom, you were bearish on defense yesterday. We literally said sell US aerospace. Now we're buying. What changed in 24 hours?
Yeah. The Quantum Systems deal, that's a game changer. The sector's attracting real capital, not just talk. The ETF is 1% off its high, so momentum is solid.
I'm not sold. Defense tech is still a spending proxy. If the geopolitical situation stabilizes, that funding could dry up. The ETF near highs means the enthusiasm is already priced in.
Look, mate, you're the one who's always on about structural shifts. This is a startup getting an $8 billion valuation. That's a big deal. I'm with Tom on this one.
Goldman Sachs says AI, strong economy, and biotech are the three catalysts reviving small caps. The Russell 2000 ETF is just 2% below its high, and the biotech ETF is at all-time highs. Buy the Russell 2000 and biotech ETFs.
3 factors, but one of them is strong economy. That could reverse fast. Small caps are more cyclical. I need to see earnings before I jump in.
But Gerald, biotech innovation isn't slowing. Look at the biotech ETF. It's at record levels. That's a real catalyst. And AI adoption could actually benefit smaller, nimble companies.
Exactly. The rotation is real. If the marginal dollar is leaving mega-cap tech, small caps are the beneficiary. I'm bullish.
All right, I'll keep my value-tilted skepticism, but I can't deny the momentum.
Exactly.
LNG supply. Bloomberg reports Qatar's LNG export revival is stalling because tanker crossings through Hormuz are still low. The natural gas ETF is down 32% from its high, a potential squeeze. Buy natural gas.
And yet, oil flows are normalizing. That's a weird divergence. Maybe it's just a timing thing. I'd hold oil, but the natural gas trade has some logic.
Saudi Arabia is exporting the most crude since the Iran war truce, per Bloomberg. That's a massive supply influx. Sell the oil ETF, up 50% year to date, and buy the Saudi equities ETF because they benefit from higher export volumes.
Selling oil after a 50% run? Gerald, that's your kind of trade.
Yes, Tom. Even I can be short something. The supply story's real, and the peace deal changes the dynamics, but the Saudi ETF is a smart counterplay.
Now, the systemic risk. Bloomberg's macroscope piece warns record leverage is sweeping through hedge funds, banks, retail, money markets. It's not just leveraged ETFs. Buy the VIX Short-Term Futures ETF, which is 56% below its high, and sell the S&P 500 ETF, because forced deleveraging could hit.
But we've heard leverage warnings for months, and the VIX ETF keeps making new lows. The market is pricing in calm. I get it as a cheap hedge, but it could be dead money.
To be fair, that's the point of insurance. When everyone's complacent, the tail risk is underpriced. I'd rather pay a little for protection than get wiped out.
And this is systemic, not just a single ETF. If something triggers a margin call cascade, the selling could be violent. It's worth a look.
Japan Corporate. Dentsu is taking a subsidiary private with a $1.2 billion investment from Fujitsu and a trading house. That's a restructuring catalyst. Buy Dentsu, hold Fujitsu.
Refreshing. A Japanese company actually listening to activist pressure. This is good for the stock. It aligns with yesterday's Buy Japan Equities call, by the way.
Our view, the market is torn between AI growth euphoria and record leverage. The AI trade still has oxygen. NVDA and TSMC aren't at extreme valuations, but there's a rotation into small caps, and that's not a bear market. It's a regime shift.
The counterargument is the economy is strong. Earnings could surprise, and if the Fed stays put and the dollar weakens, risk assets can keep climbing. The leverage warnings have been false alarms before.
But earnings season starts in 10 days, and nobody's talking about it. With the S&P at highs and Apple surging 5% last session on iPhone buzz, the hurdle for positive surprises is high.
Also, the press is ignoring the policy vacuum in China. Beijing could respond to the subsidy pullback with stimulus, wrong-footing the shorts. That's a binary risk.
The cleanest trade is owning volatility as a hedge while staying long AI hardware names supported by actual orders. Trim oil into the Saudi supply surge and keep an eye on the eurodollar.
Fair enough.
Yeah, that's sensible.
All right, trimmed.
And as always, none of this is investment advice. If you're just finding us, hit follow on Spotify or check investmentflash.com for the full digest with charts and sources.
We're back at 9 a.m. New York time for the New York edition. See you then.
Quick on the pulse. Investment Flash. Investment Flash. We move so fast. Flash, flash. Investment Flash. The market